Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I'm going to be your host here for about the next 20 minutes on Options Guide TV. We're going to be a short and sweet Options Guide TV. We don't have a trade to review because on Monday we had a market holiday for Memorial Day. So we actually took the time to put up a video about our deep in the money call adjustments in our Nvidia position inside our paper trading account, a trade that we put on back in November. I really enjoyed doing the video. And well, it's always fun to do a video on an underlying that has moved as much as Nvidia does and also moved in the right direction. So I encourage you to go back and check that. If you've ever bought a deep in the money call option as a substitute for the stock, it's a great scenario where we were able to adjust that entire position after the success of Nvidia going on beyond $1,000 and now doing a 10-for-1 stock split. So we talked about all that stuff on Monday's show. So now here we are back live. Today's date is Wednesday, May 29th. The markets are open and rocking and rolling. And I kind of hinted to this on Friday's show that we're going to look at an NDX butterfly this week. I'm still neutral to bullish on the marketplace. I still think there's a lot of chop. We did an S&P 500 index skip strike butterfly going into the record high in the S&P 500 index. Now, unfortunately, the market didn't pause at all. It just blew through the new high, and that created an issue, and we had to adjust or get out of the trade a little quickly. So now we have the NASDAQ. We have everything setting all-time highs as far as the indexes are concerned. It seems like it doesn't matter what index it is. It's either approaching an all-time high or it's very close to it. The only exception would probably be the Russell 2000 index, but that index is still a very interesting index to trade to. And we've been doing a few trades on and off here on Options Guide TV in the Russell 2000 index. So today is the day that we're going to look at an NDX, NASDAQ 100 index, and we're going to set up a skip strike butterfly in the NDX. Now, I'm going to start by showing a skip strike butterfly inside the options playbook. And we got a couple of new things that we are introducing inside the playbook. So first of all, let's zoom into the options playbook, or bring up the options playbook here to start with. And I'm going to show you the skip strike butterfly. So if we look at the skip strike butterfly inside the options playbook, one of the things that I want to note before we show some of the new things that have happened here is that if you click on this and you actually go to option strategies now, and you're looking at the drop downs and the resources, we actually now have an option strategy tab that will highlight all the different strategies. And note that there's also a search box. So if you want to just go directly to a short strangle or a long combination or a fig leaf, it will very quickly get you there. But this little drop down, I asked our programmers to add it just because I didn't like the fact that we had to scroll through the strategies just based off of the option strategy tab. So that's something new that we added. Then also on our graphics, we now show the profit and loss graph, and the note kind of depicts this from a 24-day period. So you're going from 24 days in time all the way up until that expiration date. And so if we look at the skip strike butterfly, which here's the setup, one of my favorite trades, and if you watched Options Guide TV, one of the biggest things that I've always mentioned about the skip strike butterfly is that I like the name skip strike way better than I do modified or broken wing butterfly, because it tells you what you're actually doing. You're buying strike A and selling strike B like a normal butterfly. Usually that you're going to be equidistant on the widths, and then you're buying strike C. Well, here we're actually skipping over strike C and then buying strike D. So if the width of the butterfly is 30 points wide, which that's what we're going to do in the NDX because it's a very high falutin index, a very high priced index, we're going to go 30 points wide. Well, if it's a standard butterfly, the distance between strike A and strike B would be 30 points. And then from strike B to strike C would be 30 points. The skip strike, we skip over strike C and we buy strike D. Now, it effectively embeds a short spread into the butterfly. And the credit from the short spread will then pay for the butterfly. And in order to make the skip strike where you have a profit and loss graph at expiration, a profit and loss graph that will be a net credit. In other words, you notice the purple line is above the zero line on the profit and loss graph here on the options playbook. When you highlight that and you see that, what you see is that has to be done for a net credit to the account. And I really only like to do this skip strike butterflies. I want to pick the right width of the distance between strike A and B and D in order to be able to get this done for a net credit. I don't like doing skip strike butterflies where we're adding additional risk and not have that trade done for a net credit to the account. So by skipping that strike, you're adding additional risk. It's basically the margin of the short spread that if your broker is using the risk-based margin, in other words, the total risk of the trade, because you have a benefit at expiration. If the market goes up and it gets to there, well, that long spread is going to benefit you, and that helps offset the risk here. And then all of a sudden it kicks in because you skipped over the strike, which would normally be right about here, and it adds this risk in, which is the short spread, and that lets you do this butterfly for a credit to the account. And when you do that, though, you're going to have a margin required. You're going to embed that. Now, this graphic, I'm going to work on these a little bit, but here's the concept. You actually have the little play button. And if you hit play, it shows you how the graph morphs into expiration. And it'll keep doing it over and over again until you hit stop. But if you come in and you look at the trade, it will show you to start with, and let me grab it right there. Okay, to start with, the skip strike butterfly isn't a very attractive trade in that when I first do the trade, there's not a lot of upside until we get closer and closer to the expiration date. So this would be about with 20 days remaining. And then if we go a little bit longer, now all of a sudden you got about 5 days remaining. And then you get to the expiration date and wham, right? If we're correct on our forecast, we can get the maximum, which is the width on the trade. And this is where our break-even point would be at expiration, is this line right here. All right, so let's set one up. Literally all these new additions came out today inside the options playbook, and I'm going to tweak a little bit of the graphic there. That chart doesn't quite start out right, but it'll get there. All right, so let's zoom out a little bit. And let's get to the TradeHawk software. So let me tab through these and pull up the TradeHawk software. And like I said, we're going to be short and sweet here. So NASDAQ. So the markets are showing a little bit of weakness today. Let's just pull up the markets in general. And I guess we're kind of bouncing back a little bit. There is a lot of red on the screen, though. All the stocks that we are highlighting here, we're down more in the NDX than when I first started looking at this. We're now down about 0.5%, which is 95 points. So a full percentage point would be about 200 points. And if we're looking at the SPX right now, we're down over 0.5%. So we're getting some more weakness than when I first started looking. VIX has ran up. It's up around that 14% level. So that's had a kind of a strong move to the upside. Where are our Magnificent Seven stocks? So let's look at the Mag 7, see what the good old NVDA is at right now. So that switched. That was just up a little bit, and that's now down. The biggest components of the NDX actually, NVIDIA has recently taken over Amazon. So it goes it goes Microsoft, Apple, NVIDIA, Amazon. Those are the four top stocks in the NDX. So NVIDIA has had a great run up, and it's just given a little bit back, down 2 points on the day. So neutral to bullish on this trade, and that's what the NDX is. To start with, if the markets go down when you do a skip strike butterfly, if it goes down, you're getting it done for a net credit. If all the options expire worthless, you make that net credit to the account. Now, the ideal scenario is that the market slowly starts going up towards your strike. You don't want it to go quickly, and you want at expiration to be within the wings of that standard butterfly. So if I'm setting up the trade, that is my goal. I got to have basically that forecast. I do not mind if the market goes south at all. I'm going to make a decent percentage on the margin requirement in the account, that it's worth my time to do it on a very short-term trade. I'm only going to do 2 days, and mainly that's because Monday was a holiday. We didn't tape Options Guy TV on Tuesday, so now it's Wednesday, and we're going to come up with a trade. And I don't mind doing a very short-term trade in the NDX. Part of the reason why is that right now it's trading at $18,780. Just the fact alone that the NDX is such a high-priced index, even relative to the S&P 500 index, means there's a lot of juice from a Wednesday option contract with a Friday expiration. So let's do it. May 31st is the expiration date. I always want to check and make sure it says May 31st over here. We got the calls on this side. We got the puts on this side. We are going to do a call skip strike butterfly. That means we think the market's either going to hang around here, not looking for a lot of volatility to the upside. All the Meg 7 have announced their earnings. That's a big chunk of stock. So I don't mind just doing a short call spread. Now, also, I failed to mention this when I was inside the options playbook, but I always like to look as the skip strike butterfly as an alternative to the short call spread that we mentioned. We're selling that short call spread to pay for the butterfly. To me, that butterfly that we're paying for is my hedge. I'm doing the short call spread, and I'm going to hedge by buying a butterfly. That is how I define a skip strike butterfly. So I'm approaching this as I'd like to make that net credit, but if the market goes against me, I want some protection. So here's the trade. Market right now inside the TradeHawk software, it always highlights where the most at the money option contract is at. And I have my change set up to show you where a 1 standard deviation move is at. So in this instance, it's still a decent net credit. Okay, the net credit was a little bit higher when I first came to the trade, but we're a little bit further out of the money than when I first set it up. But I'm going to ride with it because I don't mind the net credit of $1 here. So 1 standard deviation move is highlighted between the black and the gray. And you can always double check that because the delta should be somewhere around 16. So the market has moved against us. This is actually, I'd say, the real 1 standard deviation move is going to be somewhere. Yeah, market's moving fast, right around here, 1910. So we're still looking at about a 250 point move, or somewhere around 1.3, 1.4% move over the next 2 days to get to our butterfly. We're going to get this done hopefully for a net credit of $1. If the market would stop going down, we need to get the trade off, right? It was about $1.40 when I first started looking at it, but the market was down about 1/3% as opposed to 0.5% at that point in time. So I can adjust this. Yeah, market ran against us. Let's do that. We got time today because we don't have a different trade to review. So I'm going to bring this down and we'll do the 130, 160. Just make sure that we're going to skip the 90 and we got the 120. Okay. Just wanted to make sure the strikes are available, because when you get such a high point index, they don't always have all the strikes. It's just, it's just a part of the fact that you're dealing with such a high priced index overall. Sometimes the strikes get a little bit weird. Okay. So I'm going to adjust this. Let's see if we can get a little bit higher net credit. We're talking about $1 right now. We're going to do 30 points, which is more than we usually do in the SPX. Once again, it's a high priced index. So we're going to have a larger requirement for this one trade. So let's knock that out. Let's go get the 16 delta right there. We're about a 1 standard deviation move. I'm going to stick with the 30s. We're going to sell 2 of the 1960s. We'll skip the 1990s, which would be, and I'm just going to toss this in here for a second. So if we did the standard butterfly, we're looking at about 80 cents on at the midpoint, if you could fill at the midpoint, which usually the NDX is a very liquid index. You can usually get midpoint fills fairly good on butterflies and 2 and 3 legged trades. Okay, so that's the strike that we're going to skip. That would be our standard butterfly: 30 points, 30 points, 30 points. Now we're going to go up to the 120. We'll skip that, and we'll buy the 120. 140 net credit. All right. That's where I was when I first started looking at that trade. And that's the number that I'm going to put in here. Market's really moving right now. Probably should stop and figure out what's going on. But I'm going to put a 140 net credit to the account. 135. Yeah, it's all over the place. And this is going to be our paper trade for the week. And we're going to come back on Friday. We'll look at it and see how the trade works out. It needs to make more than a 1 standard deviation move, over 250 points, in order for you to start getting nervous on the trade. And then it would have to go beyond that, gets you up to the 1930 level, somewhere in that range, about 1.2 to 1.4%. If you think it can make more than a move than that, then you don't want to be in this trade. If you think it's less, there are many different scenarios where you're going to be profitable. If stock stays where it's at, if it goes south, you can make up to $1.40, $140 on every 1 by 2 by 1 skip strike butterfly that you put on. But we're skipping the 1990s and buying the 19120s. And that means we have a $3,000 requirement on this trade. And I'm doing something a little bit different. I feel fairly comfortable because of the way that we're going to set this up. Our biggest risk is that if it makes a move right now, let's say it moves, it's down 100 points. Let's say it moves 100 points back up and ends up flat on the day. We're going to be down on this position, and we're not going to have a lot of time decay. It's only going to make half the move towards our long strike. So to start with, we would like the market to slowly go back up, and then tomorrow it can start moving. That would be very nice if it did that on Thursday. And then on Friday, you would love it if you could land somewhere between 19,030 and 19,060. Somewhere within that range would be a home run basically on this trade. We're going to put this on for a net credit of 140. If we can, if we do everything right and the market goes with us, and it does land somewhere within the width of the standard butterfly on our trade, we might even be able to take it off for a net credit to the account. And that's one of the things that I love. So you're putting it on, you are getting into the trade, you're opening the trade at a net credit, and then you'd be closing the trade at a net credit to the account. Now, if the market just starts going south, well, we'll just collect our $1.40, our $140 on our $3,000 requirement. It's worth doing. It's not a lot on a percentage basis. But the one thing about the skip strike butterfly too is that I don't feel a need to have to close it out. If we're going to expiration and let's say you got 10 cents or 20 cents that to close out that trade out of the $1.40, not too nervous about it, because if it starts coming back, I still got the butterfly in on the trade. And as expiration approaches, that butterfly is going to be much happier if you land around the short strike at the expiration date than if it just went out worthless. So I'm not closing this trade out and trying to grab or trying to remove the position when I have only 10 cents left in the trade in the option contracts. I'm just going to let it ride and go all the way to zero if it starts going that way. So let's take a peek at the what if calculator. And by the way, this is a good time to say that if you are in the Tradier YouTube platform, you can actually ask questions. You'll see that chat box and they will come up and I'll try to address them. We're also streaming live on x.com and streaming inside the Tradier Hub. And if you haven't done so, please check out the Tradier Hub and see all the different speakers that we have, really building out a real nice lineup of speakers inside the hub. All right, here's where the market's at. I'm going to zoom in this way. And this kind of shows you what we saw inside the options playbook. To start with, when you first look at this trade, it doesn't look that great, right? This is the profit and loss graph as of today, if we executed it for around $1.40 net credit to the account. Right now, it's saying you could do it at $1.35 because it's $135 if it goes south. As we go through this direction, it hurts. It hurts to start with. But we only have 2 days left in the trade. So I'm going to try zooming back in a little bit. Let's zoom a little bit better. Okay. So now if I move this, just even by tomorrow at 11 o'clock, now it's time stamped. It's 11 o'clock on the 29th. Let's go to the 30th. And the market moves up. And we're still kind of nervous about this trade, right? Not enough time to happen because you have such a high dollar index. Now, if we go to Friday, things will look a little bit better, right? Now that we're within that range, we're doing a little bit better, but it even gets a lot better if we go to, let's add 2 more hours to the Army time. Now let's add another hour. And then eventually it's got to go all the way to there on expiration, right? So you're not feeling really comfortable as you're approaching your short strike until, well, also implied volatility could come off. That could help a little bit too. But until you're getting to the last half of the day on Friday, and this is just a 2-day trade. But if the market came all the way down and I could close it out for 10 cents, why? I would rather have the market come back up and have a chance of making somewhere within this range. And then if you get all the way to that expiration date on this trade too, there's with 1 hour left, let's go to 1620. Now you're at the profit and loss graph exactly at that expiration date. That would be 4:20 time on Friday Eastern time. Markets would be closed. So if you have any questions or any comments, please do put them in the chat box. I will try to address them. I think this is an interesting trade where the market is at. NVIDIA, if we get a little bit of a pullback in that, that means we might be able to get this to just expire worthless, making that $1.40. We have 1 day that we're a little sketchy on. The market goes up more than 1%. Right now, we're looking at a market that is about 0.5%, and that's 87 points. We would need to go more than 1 standard deviation move. In that instance, that's about 1.4% before we really start getting nervous on the trade. I don't mind this one. I don't mind it at all. That's it for this edition of Options Guide TV. If you are in the Tradier YouTube platform, please click subscribe, ring the bell so you get all of the notifications. If you'd like to learn more about these strategies and review anything, please check out my Twitter. It's handle @BrianOverby. And as always, if you have any questions about options, please run to optionsplaybook.com and check it out. Thanks for coming, everyone. I'll see you this Friday, 11 a.m. Eastern time for the next edition of Options Guy TV.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy. and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.